So you're ready to dive into the world of crypto trading, but you don't exactly know where to start. You're not alone. One of the most frequently searched questions in crypto right now is, how do I start trading cryptocurrencies? And while trading might seem overwhelming at first, even daunting, getting started is actually much easier than you may think, as long as you understand the basics. The first step in crypto trading is choosing the right exchange. Popular platforms like Binance, Coinbase, Kraken, and Bybit offer beginning-friendly interfaces with deep liquidity, while decentralized exchanges, known as DEXs, like Uniswap and Radium, allow for non-custodial trading. Once you've selected an exchange, you'll need to set up an account, verify your identity, and deposit funds, whether it's fiat currency or another cryptocurrency. From there, the real learning begins. Understanding order types, market dynamics, and risk management is crucial before making your first trade. Once you're all set up, you'll need to decide on a trading strategy. Are you a long-term investor, a hodler, a short-term trader, a scalper? Or maybe you're someone that's just looking to ride the trends like a swing trader. Understanding your risk tolerance and trading style will help you determine whether you're better off holding assets through market cycles or actively trading for short-term gains. No matter your approach, learning technical analysis, market trends, and proper risk management will be the key to your success. Now that you know how to get started with trading, let's actually take a moment to talk about trading strategies. Because blindly buying and selling is a great way to lose your money very fast. One of the most searched questions right now is, what's the best buying strategy for trading crypto? And the truth is, it depends on the market conditions and your trading style. Some traders thrive in the bull markets, while others, they specialize in profiting from volatility in sideways or even very bearish markets. The key? Well, that would be knowing which strategy to use at the right time. For long-term traders, the HODL strategy is the easiest way and often the most effective. This approach involves buying strong assets like Bitcoin and Ethereum and holding them for years, regardless of short-term price fluctuations. Then there's swing trading, where traders look for midterm trends, buying on dips and selling on rallies. This works really well in bull markets, where uptrends are more predictable. For more active traders, day trading and scalping involves making multiple trades per day, capitalizing on small price movements. These strategies require more experience and more discipline, as quick decisions and risk management are crucial. One of the most important things to understand is that no single strategy works all the time. A strategy that performs well in a bull market might in fact lead to massive losses in a bear market. For example, in a downtrend, traders might use shorting strategies, leveraging trading, or options to profit from falling prices. Meanwhile, in sideways markets, techniques like range trading, buying at support and selling at resistance, become more effective. The best traders stay flexible, analyze the market conditions, and adjust their strategies accordingly. One of the biggest debates in crypto trading right now is technical analysis versus fundamental analysis. Some traders swear by charts, indicators, and price action, while others focus on tokenomics, project adoption, and market trends. But which one is actually better? The truth is, both are valuable, and understanding how to actually use them together can make you a more successful trader. Technical analysis, well, that would be all about predicting future price movements based on past market data. Traders use candlestick charts, trend lines, moving averages, and indicators like RSI, MACD, and Bollinger Bands to identify patterns to potential entry and exit points. Technical analysis works really well for short-term traders because crypto prices often move based on psychology and historical patterns rather than fundamentals. If you've ever seen a trader say, Bitcoin just broke resistance, we're going to $50,000. They're using technical analysis to make that prediction. Fundamental analysis, on the other hand, looks at the bigger picture. It focuses on a project's real value, utility, adoption, and long-term potential. Fundamental analysis traders analyze things like tokenomics, development teams, and partnerships, maybe even on-chain activity. And don't forget market demand. For example, If a layer 1 blockchain like Solana is seeing massive growth in daily transactions and DeFi adoption, a fundamental analysis trader might invest early before the price reflects its real value. The best traders use a combination of both fundamental analysis and technical analysis for timing their trades accordingly and choosing the right assets to trade in the first place. If there's one thing that separates successful traders from broke traders, it's risk management. One of the most searched questions in crypto trading is, how do I avoid losing all my money? Well, the answer isn't just about picking the right coins. It's in fact about protecting your capital, limiting your losses, and do not forget, making smart decisions, even when trades don't go your way. No matter how good you are at technical analysis or spotting trends, if you don't manage risk properly, the market will punish you. The first rule of risk management is never risk more than you can afford to lose. A common guideline is only risk 1 to 2% of your total portfolio per trade. This way, even if you have multiple losing trades in a row, you'll still have capital left to recover. Setting stop loss orders is another crucial tool. This automatically exits your position at a predefined price to limit your losses before they spiral out of control. Smart traders also utilize take profit levels, which lock in gains when a price target is actually reached. Trading without a stop loss is like driving without a seatbelt. You might be fine for most of the time, but when a crash actually happens, it's game over. Another major mistake is over leveraging. Many beginners get lured into utilizing high leverage 10x, 50x, even 100x because it promises bigger gains. But leverage also amplifies losses, and one bad trade can wipe out an entire portfolio. Instead, experienced traders use low or moderate leverage, 2x, maybe 5x, and when necessary, managing risk also means diversifying your trades. Do not go all in on one asset. No matter how bullish it may look, don't ever do it. The crypto market is unpredictable, and even the best setups can fail. The goal is not to win every trade, but in fact, to survive long enough to win over time. Why are your emotions your biggest enemy? Well, for starters, if you've ever panic sold at the bottom of FOMO'd into a pump just before a crash, you're not alone. One of the most searched questions in crypto trading is, how do I control my emotions while trading? The truth is, trading psychology is just as important as technical skills. And for most traders, emotions are the biggest reasons why they lose their money. Fear, greed, impatience, and overconfidence can inevitably turn a winning strategy into a disaster. If you don't master your emotions, the market will control you. The two most dangerous emotions in trading are fear and greed. Fear causes traders to panic sell when prices drop, locking in losses instead of waiting for a potential recovery. Greed, on the other hand, well, greed makes traders chase pumps, use too much leverage, or refuse to take profits, only to watch their gains disappear when the market reverses. The best traders, well, they operate with logic, discipline, and a very clear strategy, not emotions. They set entry and exit targets before placing a trade, use stop losses to manage risk, and ready for this one? Stick to their plan no matter what or how they feel in the moment. One of the best ways to improve trading psychology is to remove emotions from your trades entirely. Utilize a structured approach like journaling every trade to track your decisions, mistakes, and emotional reactions. Learn to accept losses as a part of the game. Even the best traders only win 55 to 60% of the time. Please keep that in mind. But they make sure their winners are bigger than their losers. And most importantly, never trade based on hype, social media, or what influencers have been or are saying. The market does not care about emotions, and neither should you. Trade with a plan, stay disciplined, and you'll already be ahead of 90% of the traders. How to find the next big trade. Spotting the high potential opportunities. I know, everyone tries to look for them. Where do you get them? Where do you find them? Where do you search? One of the most common questions in trading, well, it's how do I find the next big trade before it blows up? The truth is, spotting high potential opportunities takes a mix of research, market awareness, and understanding hype cycles, whether it's meme coins going parabolic, undervalued DeFi gems, or trading narratives like AI tokens, the key is being ahead of the crowd, not chasing after pumps once they've already happened. A fantastic starting point is on-chain data. Tools like Look On-Chain, Nansen, and DBank track whale movements, new token activity, and smart money inflows, giving you a real-time look at where big players are positioning themselves. If a well-known crypto fund or trader is accumulating a token before it trends, it's often a good signal to pay attention. Another strong indicator is social sentiment. Coins that start trending on Twitter or X, Telegram, and Discord often see explosive price action if the momentum keeps building. Beyond that hype, you also need to evaluate the fundamentals. If a project has strong tokenomics, a solid team, and real adoption, well, it's far more likely to sustain its growth rather than being a pump and dump. Ask yourself, is the project solving a real problem? Does it have long-term potential? Or is it just riding a temporary wave? A combination of on-chain analysis, social sentiment, and fundamental research will give you an edge in finding winning trades before they go mainstream. And please remember, being early is fantastic, but risk management is key. Not every hype token is the next 100x, so always size your positions accordingly. Even the best traders make mistakes, but the difference between winning and losing in crypto, it's learning from them before they wipe out your portfolio. Some of the most searched questions in trading are, what are the biggest mistakes crypto traders make, and why do most of the traders lose money? The reality is, most losses aren't due to bad luck. They're actually due to risk management, poor risk management, emotional decisions, and ignoring basic trading principles. Let's break down the most common mistakes and how to avoid them. The first major mistake is overtrading. Many beginners think that they need to trade constantly to make money, but more trades often lead to more losses. The best traders will wait for high probability setups and only trade when the odds are in their favor. Another killer mistake, chasing pumps. If you see a coin go up 200% in a day, you are already too late. Buying into the top, well, it often leads to getting wrecked when the hype dies down and early buyers take profits. Instead of chasing, learn to identify strong entry points before a coin takes off. Another common pitfall is falling for scams, rug pulls, and fake hype. If a project is promising guaranteed returns, endless passive income, or the next 100x, it's probably a scam. Always research the team, liquidity, token unlock schedules, and WoW wallets before investing. And finally, ignoring trading fees and slippage can silently eat into your profits. If you're making multiple trades on low liquidity tokens or using high leverage platforms, hidden fees can drain your account much faster than you realize. The key to avoiding these mistakes? Stick to a plan, stay disciplined, and always manage your risk before placing your trade. What's changing in 2025 and beyond for crypto? Well, crypto trading is evolving faster than ever, and the strategies that worked a year ago, they may not be as effective in the future. So some of the most searched questions in the space currently are, what is the future of crypto trading? And how is trading changing in 2025? The industry is shifting rapidly, with AI-powered trading, institutional adoption, and regulatory changes shaping what comes next. If you want to stay ahead, understanding these trends is crucial. One of the biggest shifts is AI-driven and algorithmic trading. More traders, both retail and institutional, are utilizing automated bots, AI-powered trading models, and machine learning algorithms to gain an edge in the market. Platforms like Hyperliquid and AI-powered trading bots are making it easier for traders to execute precise strategies without manually analyzing charts all day. This means that trading is becoming more data-driven and less emotional, and traders who don't adapt, well, you could struggle to keep up. Another major development is the rise of tokenized real-world assets and on-chain derivatives. As traditional finance moves on-chain, we are finally seeing tokenized stocks, bonds, and commodities being integrated into DeFi. This could lead to more regulated and stable trading environments. but also more competition from institutional players. Additionally, the growth of perpetual futures, options trading, and cross-chain liquidity solutions is making crypto trading more advanced than ever before. The key takeaway, the landscape is changing, and fast. Traders who embrace automation, on-chain analytics, and evolving market structures will have a massive advantage over those who do stick to outdated strategies. Crypto trading, it's not just about buying low and selling high. It's actually about understanding the market, managing the risk, and staying ahead of the trends. Whether you're just getting started or looking to actually refine your strategy, the key to long-term success is discipline, patience, and continuous learning. The market is always changing and ever evolving. The best traders learn how to adapt and never stop improving their skills. We've covered everything from getting started and choosing a strategy to risk management, trading psychology, and spotting the next big opportunity. We also explored the biggest trading mistakes to avoid and what the future of trading actually looks like in 2025 and beyond. The question is, how will you use this knowledge? Whether you're a scalper, a swing trader, or a long-term investor, the next step is to apply what you've learned, build a solid trading plan, and stay consistent. If you found this video helpful, be sure to hit that like button and subscribe so you never miss an update on the latest crypto insights from JRNY TV. Thanks for watching, and we will see you next time.